Martin, great to have you on. I'm looking at Brent right now. It's 96.90. We're going to hit 100 here in the coming days, do you expect?
All of a sudden, 100 is not so far away anymore.
That's right.
Look, over much of the summer, the outlook looked a little weaker, but all of a sudden, we have quite a lot to work with on the bullish side of the ledger again.
So let's talk a little bit about what you're working with on the bullish side of the ledger and what that means for prices in the near term and also in the long term, because at some point, if crude moves high enough, it starts to destroy demand.
Yeah, that latter comment is definitely true. That is where we were in June of this year. In June, Brent crude oil peaked at around about $130 a barrel. But what really drove the demand destruction that followed from there were these very, very high product prices. Gasoline was $180 a barrel. Diesel was briefly $190 a barrel. We also had bottlenecks in refining, and that drove these product prices up very, very sharply. Since then, crude oil prices have come off. We're not at 120, 130 anymore. But also the refining margins have weakened. They're still high in historical context, but they are a lot lower than they were in June. And so from that perspective, we are nowhere near prices that cause demand destruction. So from that perspective, there is room to rally again. Now we have a confluence of, I would say, three set of important factors. One is the OPEC cut that you mentioned. This is really OPEC asserting itself. This is an unexpected large cut. On top of that, we have at least the potential for a sizable disruption in the flow of oil from Russia. This remains somewhat uncertain, but that potentially is definitely there when the EU embargo comes in. And then we also have potentially the SPR release running out. All of that is coming together over the next couple of weeks, month or two. And when those things come together, I think that will put upward pressure on prices again.
And of course, you're talking about over the next couple of weeks, month or two. In the meantime, here in the U.S., we have a midterm election. So when you look at what the Biden administration is potentially, reportedly considering in terms of a response to OPEC right now, whether it's tamping down on U.S. fuel exports, whether it's so-called NOPEC, some of these other potential policies that could make their way both through the executive suite and through Congress, what is your expectation and what would the ramifications to the broader market be?
Well, it's not so easy to come with a set of measures that put more pressure on OPEC, whilst at the same time also calming oil prices down. The Venn diagram between those two measures actually isn't really all that large, and it doesn't contain a lot of things that the government could arguably do. I think one of the reasons why OPEC has been so assertive on this occasion is that they arguably have quite a lot of control over the oil market. Their market share has risen again recently. Their production levels are very high, so they, particularly in the core Middle Eastern OPEC countries, so there is room to lower production. Spare capacity is low. There are not an awful lot of other countries that can step in and grow production quite sharply. So I think they probably looked at the broader landscape of potential sort of ramifications, counter moves, and concluded that, frankly, at this moment, they have the capacity that if they want higher prices, they can probably get it.
Shepard Smith here. Thanks for watching CNBC on YouTube.